Stop what you're doing. This is not another market update you casually listen to. What happened last night altered the structure of the silver market, and almost no one understands the significance. If you miss this moment, you won't just miss a trade, you'll miss the reason the game is being forced to change. It is Tuesday, January 13th, 2026. Silver just crossed $85 an ounce. Shanghai traded higher. For a brief moment, physical reality broke through the paper illusion. Arbitrage began to fail. Pressure built, control slipped, and then the system reacted. Not with headlines or explanations, with a rule change. Quiet, immediate, surgical. Overnight, the exchange that governs silver futures rewrote the terms of participation. No warning, no delay, effective immediately. One move designed to trigger fear-force selling and push a specific group out of the market, retail traders who were finally winning. This is how real market power operates. Not through fundamentals, but through structure, through leverage, through margin, through rules that decide who survives volatility. When price threatens power, the system doesn't debate it, intervenes. If you woke up to red candles and doubt this morning, understand this clearly, that reaction was engineered. Fear is not an accident, it is a tool. And this is not new. It is a pattern repeated every time precious metals expose systemic weakness. Once you recognize it, panic disappears and clarity takes its place. In the next chapter, I will explain exactly what was changed, how it works, and why it forces liquidation even when you are right. Type 1. To continue to Chapter 2. Type 2. To stop here. If this already sounds different from what you hear elsewhere, subscribe and comment. 1. So we keep going. To understand what just happened, you need to understand one uncomfortable truth about futures markets being right is not enough. You can be early. You can be correct on fundamentals. You can even be positioned for a historic breakout and still be forced out against your will. That is exactly what margin is designed to do. A silver futures contract does not require you to pay the full value of the metal. One contract controls 5,000 ounces. At $85 an ounce, that is over $400,000 of silver. But until yesterday, you only needed a fraction of that as collateral, roughly $32,000. That leverage is what allowed ordinary traders to participate in a market dominated by institutions. And that leverage was the problem. Under the old system, margin was fixed. It did not matter if silver was at 50.70 or 85, the requirement stayed the same. That stability allowed retail traders to hold positions during volatility. It allowed them to survive pullbacks. It allowed them to stay in the game long enough for fundamentals to matter. That stability is gone. Effective immediately margin is no longer a fixed number. It is now a percentage of the total contract value. As price rises, margin rises with it. On paper, that sounds reasonable. In reality, it is devastating. Because when margin jumps overnight, your broker does not ask if you agree. They demand cash. If you do not add capital immediately, your position is liquidated at market price. Not because you were wrong. Not because demand fell. Not because supply increased. But because the rules changed while you were already committed. Now multiply that by thousands of traders at the same time. Forced selling hits the market all at once. Price drops. Charts turn red. Panic spreads. And suddenly the narrative flips from strength to failure even though nothing fundamental changed. This is not volatility. This is engineered pressure. The key insight is this: margin changes do not reflect risk. They create it. They are not neutral. They are timing tools. And when they are deployed at moments of maximum leverage, they function like a trapdoor. In the next chapter, I will show you why this tactic has been used before when it was used and how the outcome always looks the same in the short term and very different in the long term. If this feels familiar, it should. What you are witnessing right now is not innovation, it is repetition. The silver market has seen this movie before, and every time the setup is the same. Price breaks higher, momentum builds, retail participation increases. And then right at the moment pressure becomes unbearable, the rules change. Go back to 2011, silver was climbing relentlessly. Demand was rising. Confidence was spreading. Retail traders were finally applying real pressure to a system built on paper promises. The narrative was identical to today's shortage's delivery risk, a disconnect between paper price and physical reality. Then the exchange intervened. Margins were raised again and again in rapid succession, not once, not twice, multiple times in days. Each increase forced more liquidation. Each liquidation pushed price lower. Each drop reinforced fear. And to the outside world, it looked like the rally had failed on its own. But that was the illusion. Nothing fundamental collapsed. Mines did not flood the market with new supply. Industrial demand did not vanish. What collapsed was positioning. Leverage was stripped away until only the strongest hands remained or until most retail traders were gone. This is how engineered sell-offs work. They do not destroy the trend. They reset ownership. After the forced liquidation, silver did what it always does. It stabilized. It rebuilt. And eventually it ran far higher than most people believe possible. The ones who were shaken out never got back in. They remembered only the pain, not the pattern. This is the most important lesson markets teach over and over. Short-term price action is often a weapon, not a signal. When you confuse the two, you become liquidity for someone else's exit. What is happening now fits the historical script perfectly. A breakout, a margin shock, a forced sell-off, fear, headlines declaring the move over, and quietly underneath it all, the same unresolved pressure. In the next chapter, we move forward to why this time carries far greater consequences than any cycle before, because the backdrop has changed and the system is far more fragile. Every cycle feels unique when you are living through it, but this one truly is. Not because markets are emotional, but because the foundation underneath them has changed. In the past, margin manipulation could delay the outcome. Today, it can only expose how little control remains. In earlier cycles, silver was primarily a monetary metal. Industrial demand existed, but it was secondary. Today, that hierarchy is reversed. Silver is no longer optional. It is embedded in energy infrastructure, electronics, defense systems, and supply chains that cannot simply pause when prices rise. Demand does not negotiate with futures exchanges. At the same time, supply is no longer elastic. New mines take years to develop. Ore grades are declining. Environmental and geopolitical constraints are tightening. And most importantly, major producing regions are no longer guaranteed exporters. When physical metal stops flowing freely, paper pricing becomes a suggestion, not a reality. This is why the gap matters. The growing premium between futures prices and physical markets is not noise. It is a stress fracture. It tells you that the paper system is struggling to clear real demand. Margin hikes may suppress screens, but they do nothing to refill vaults. This is where the system becomes fragile. Because once industrial buyers are forced to compete with investors for physical supply, the market stops behaving like a financial asset and starts behaving like a necessity. At that point, volatility is no longer controlled by traders. It is driven by procurement. The reason this matters now is simple. Leverage can be removed from traders, but it cannot be removed from factories, utilities, or national stockpiles. They buy regardless of sentiment. They buy regardless of margin rules. And when they buy, they do not roll contracts, they take delivery. This is why rule changes feel aggressive. They are not preventative, they are reactive. And reactive systems act only when pressure is already overwhelming. In the next chapter, we will connect this structural fragility to the broader macro environment, because what is happening in silver is not isolated. It is a symptom of something much larger unfolding across the global financial system. What is happening in silver cannot be separated from what is happening in the global economy. Markets do not move in isolation. They move as reactions to stress, imbalance, and loss of confidence. And right now, multiple warning signals are flashing at the same time. There is a pattern that repeats across modern financial history. When capital begins to migrate aggressively into hard assets, it is not chasing returns, it is fleeing risk. Gold does not surge because the world feels safe. It surges because something underneath the system is breaking. Liquidity tightens. Debt becomes unserviceable. Trust erodes. Every major economic downturn of the last 50 years was preceded by this same behavior. Hard assets rise first, then growth slows, then credit fractures. By the time recession becomes obvious, the positioning has already been done. This is why precious metals often behave counterintuitively during the early stages of crisis. In the initial shock, everything sells off. Stocks, bonds, commodities, everything. Not because fundamentals vanish, but because liquidity becomes more valuable than conviction. Margin calls force liquidation. Cash becomes king for a brief, violent moment. Most people mistake that phase for failure. It is not. It is the reset. What follows is always the same response. Central banks intervene, rates are cut, balance sheets expand, currency supply increases, and once liquidity floods back into the system, capital seeks protection again. That is when hard assets move not in steps, but in leaps. This is the phase markets are positioning for now. Not growth, not stability, protection. And silver, because of its dual role as both industrial necessity and monetary hedge, becomes uniquely sensitive to that transition. This is why the current volatility feels confusing. Two forces are colliding: short-term liquidity stress and long-term structural demand. The paper market reflects the first. The physical market reflects the second. In the next chapter, we will look at how these forces resolve and why attempts to suppress price now may actually accelerate the move later. Every major bull market has a moment where conviction is tested. Not with logic, but with pressure. Not with debate, but with force. This is that moment. What you are seeing now is not the end of a trend. It is the stress test before continuation. When liquidity tightens, markets do not reward patience immediately. They punish it. Positions that rely on leverage are the first to be attacked. Volatility spikes, confidence fractures, and narratives shift from inevitability to doubt almost overnight. This is not accidental. It is how excess positioning is cleared. The mistake most people make is assuming price equals truth. In reality, price often reflects who was forced to act, not who was right. During liquidation phases, the weakest balance sheets dictate movement, not the strongest thesis. This is why engineered sell-offs feel irrational. They are not responding to information, they are responding to pressure. And once that pressure exhausts itself, the market does not return gently. It reprices violently. Silver is uniquely positioned in this dynamic, because while leveraged positions can be eliminated quickly, physical demand cannot. Industrial buyers do not stop because futures prices fluctuate. They secure supply because production lines depend on it. That demand operates on a different timeline than speculation. This creates a vacuum. As paper selling intensifies, physical accumulation continues quietly. Inventory drains, lead times extend, premiums widen, and the longer that disconnect persists, the more unstable the pricing mechanism becomes. This is why the current phase feels uncomfortable. It is designed to be. The goal is not to convince you, it is to exhaust you. To make holding feel harder than selling. To make clarity feel lonely. But history shows that once this phase ends, the move that follows is not incremental. It is repricing. And repricing does not ask for permission. In the next chapter, we will look at the critical difference between paper exposure and physical ownership, and why that distinction determines who remains in the market when structure finally breaks. There is one distinction that determines who survives moments like this, and most people recognize it too late. It is the difference between exposure and ownership, between a claim on silver and silver itself. Paper instruments offer speed and leverage. They let you participate easily, but only on the system's terms. Margins can change. Trading can halt. Positions can be closed without your consent. Your exposure exists only as long as the rules allow it. Physical metal does not operate under those conditions. It does not receive margin calls. It does not expire. It cannot be forced out of your hands by a policy decision. Once owned outright, it leaves the financial system and enters reality. This is why paper markets are always pressured first. They are adjustable, enforceable, Physical markets are not. They respond only to availability and demand. When supply tightens, price eventually follows regardless of what derivatives suggest in the short term. When paper prices soften under forced selling while physical premiums rise, that is not a contradiction. It is confirmation. Metal is moving into stronger hands. In unstable environments, resilience matters more than precision. The ones who remain are not the fastest, but the ones who cannot be forced out. In the next chapter, we will look at what happens when enough metal leaves the paper system and why pricing can no longer be controlled. Markets reach a breaking point not with noise but with absence. Not when everyone is buying, but when there is nothing left to sell. This is the moment paper systems fear most, the moment claims exceed reality. Every futures market functions on the assumption that most participants will never demand delivery. Contracts are rolled, positions are netted, metal stays in vaults on paper. But when confidence erodes and physical ownership rises, that assumption begins to fail. As more silver leaves the paper system, inventory thins. Delivery timelines stretch. Premiums widen. None of this appears immediately on price charts, but it appears everywhere else. In procurement contracts, in supplier negotiations, in quiet rationing. This is the point where control shifts. Paper markets can still trade, but they lose authority. Price becomes reactive instead of directive. It follows availability rather than sentiment. Attempts to suppress price at this stage do not resolve pressure, they concentrate it. Every delay increases the imbalance. Every forced liquidation transfers metal from weak hands to strong ones. And once enough metal exits circulation, the system faces a choice: reprice or fail. Repricing is never gentle. It does not happen in increments, it happens in gaps. Because when buyers compete for scarcity instead of abundance, price no longer seeks equilibrium, it seeks supply. This is why rule changes feel desperate at this stage. They are not meant to restore order. They are meant to buy time. Time for short positions to exit, time for exposure to be reduced, time for pressure to be redirected, but time does not create metal. In the next chapter, we will examine what that repricing looks like historically and why it tends to arrive faster than anyone expects. Most people imagine repricing as a smooth process, a gradual climb, a series of higher highs that gives everyone time to react. That is not how it works when structure breaks. Repricing is not a trend, it is an event. Historically, when paper markets lose authority, price does not move because sentiment changes. It moves because availability disappears, sellers step back, bids gap higher. And suddenly the market is not negotiating, it is chasing. This is why the biggest moves in commodities do not occur during optimism. They occur after exhaustion, after disbelief, after most participants have already been pushed out and sworn they will never return. By the time confidence comes back, price is already far beyond where it should be. In these moments, valuation models fail, ratios fail, anchors fail. The market is no longer pricing silver against history or averages. It is pricing against urgency, against replacement cost, against the risk of not having supply when it is needed. This is also why upside moves feel irrational to observers. They ask who would buy at these levels. The answer is simple: those who must. Industrial buyers, strategic reserves, entities for whom silver is not an investment but a requirement. Once that phase begins, volatility changes character. Pullbacks become shallow, rallies become vertical. And every attempt to suppress price becomes fuel, because it delays adjustment while pressure continues to build underneath. This is the stage markets reach, when narrative no longer matters. Only flow does. Metal moves. Inventory drains, and price follows not because anyone wants it to, but because there is no alternative. In the final chapter, we will bring everything together. The structure, the signals, the strategy, and most importantly, what lessons this moment offers for anyone trying to navigate markets that are no longer stable, but transforming. What this moment demands is not prediction, but understanding. Markets that are stable reward optimization. Markets that are breaking reward positioning. The difference is subtle but decisive. Everything we have walked through leads to one conclusion. This is not a failure of silver. It is a stress response of the system built around it. Rule changes. Forced liquidation and volatility are not signals to abandon a thesis. They are signals that pressure has become uncomfortable for those who control the structure. The lesson is simple but difficult to execute. Price is not truth in the short term. Structure is. And when structure begins to fracture, the goal is not to trade noise but to survive transition. The strategy in moments like this is clarity over